Hi everybody, welcome back to Compounding Everything. For those of you that are new here, my name's Chris and this channel is all about investing, finance and business. Now, I just finished reading this little book called The Dip by Seth Godin, and it got me thinking about investing psychology as a whole and how sometimes we're our own worst enemy or enemies when it comes to negatively impacting our portfolio returns. So I started taking investing as a whole, and when I say investing, value investing and looking for quality companies more seriously in kind of 2017, just as I was kind of finishing up as, I guess, a day trader. And throughout that period, I noticed over and over again that short-term panic or emotional stress would often cause me to make short-term irrational decisions. And I mean, you guys know what I'm talking about when, I guess, you buy into a company and it dips, say, 5% or 50%, and you think, crap, what have I done? Did I just sign up to lose all of my money? And you're kind of panicking. And I guess that's where my day trading experience kind of led me astray a little bit with long-term investing, because in day trading, the aim of the game is profits. You're not spending too much time looking at the qualitative aspects of a company. So when you come across to being a full-time investor, especially a value investor, you kind of start to realize that you have to switch your mind to a different place. So I kind of spent months trying to figure out where I was going wrong. Was I overcommitting too much of my portfolio to the investment? Was I just a horrible investor, or was I unlucky when these situations arose? And over time, I learned that detaching my emotions or fear of loss from my investing decisions helped me become a better investor. And although this book isn't about investing, it does sort of directly correlate with how we make our investing decisions. It shows us that sometimes when it feels like you're in the worst position, you could be getting closer to what you're seeking. On the other hand, it also shows you how you can identify when you aren't actually on that path that you're hoping or you think that you're on. So in this book, Seth is really sort of focusing on taking us through how we can tell the difference between a dip and a cliff. And what's interesting is that we actually have these scenarios or similar scenarios playing out every day in the stock market. You've got fantastic companies that might even be undervalued, with shareholders that are digging their heels in while watching other companies double or quadruple in value. And they sort of get that FOMO feeling. And as we saw last year, those dips turned into some of the most significant rewards in history for patient investors. In saying that, just like we have plenty of dips, we also have plenty of cliffs on the stock market. Now, the difference between a cliff and a dip is simple, but sometimes it's hard to see in, I guess, the first person. So in the book, Seth kind of identifies a dip to look like this. And it's kind of where you start off going really well, but then everything you were doing just isn't sticking anymore. You try and try, but it doesn't work. This is often where most people quit, and sometimes that is the right choice, but the only way to know is by assessing the why. It might be, why am I investing in this company? Why am I sort of sticking into this job? Why am I studying this subject? Because once you have that why firmly implanted in your mind and justified with a rational plan, you'll always find that the dip turns into a positive outcome one way or another. However, a cliff is a situation where you might be working really hard, or you might have invested a certain amount in a company, believing that there is a pot of gold at the end without any real justification. You're always working hard and going for it, but you don't know why and how that's going to play out. And ultimately, that results in a massive loss. That loss could have been the time you put into something, or money, or anything else really. Now, in the investing world, a real-world example of a cliff might be something like a value trap, or buying into a company that's overvalued or overhyped while underperforming. You're sticking with that investment just because it feels good or someone has told you to. And the problem with those situations is not necessarily that you will lose all of your money. It's just that when that cliff happens and you find yourself in a potential dip, it's very hard to justify why you're there. And like I said before, the only way to justify the difference between a dip and a cliff is with the why. Understanding the qualitative and quantitative factors of that investment and going, no, I think this company, or I know this company is going to do this over the next 10 years, and that's why I'm invested. The share price means nothing. Now, that's all well and good, but you're probably thinking, how do I know when to quit and when to stick? And in the book, Seth mentions 3 questions. The first is, am I panicking? The second is, who am I trying to influence? And the third is, what sort of measurable progress am I making? Now, I think if we take these 3 questions and we tweak them a little to suit us as investors, we could probably come up with something like, am I selling this company because the price went down or because the long-term outlook of the company has changed? One of the other questions could be, did I buy this company for the right reasons or am I in no man's land? And the final question could be, is this company still representing the same quantitative and qualitative values as when I purchased it, and how can those be measured? Now, if you've answered these rationally and truthfully, these 3 questions will help you decide if you're in a dip or on a potential cliff. So there is one more section in this book that really grabbed my attention. It was focusing on quitting before you start. Essentially, the idea is to write down everything that could cause you to quit what you're trying to achieve. So you'd write down under what circumstances you're willing to quit and when. Now, in the book, there's a really good real-world example via a quote from Dick Collins, the ultra-marathon runner. Essentially, what he says is, decide before the race the conditions that will cause you to stop and drop out. You don't want to be out there saying, oh, my legs hurt, or I'm a little dehydrated, I'm sleepy, I'm tired, or it's cold and windy out here. Because then you're going to put yourself in a position where you talk yourself into quitting. The exact same thing is relevant when we're investing. If you're making those decisions based on how you feel at that moment in time when the share price is 10% down or even 10 or 100% up, you'll probably be making the wrong decisions. It's just common sense. So why do we think that we can go and make significant investments without a good plan and first deciding when we'll quit and why? Because once you've done that, investing is easy. You've managed the risk, you've taken your emotions off the table, and you've prepared yourself logically and reasonably. And yes, it sounds so simple, right? In a perfect world, we would all do this before we buy a stock or make big choices in life. But if you're already past that point and you're watching this video and you're not too sure where you stand, perhaps first establish if you're in a dip or if you're on a cliff by asking yourself, am I selling this company because the price went down or the long-term company outlook has negatively changed? Did I buy this company for the right reasons or am I in no man's land? And finally, is this company still representing the same quantitative and qualitative values as when I purchased it? And can that be measured? These questions, if answered truthfully, will help you decide if your holdings are entangled in a dip or on the edge of a cliff. There are many helpful gems in this book that can be easily transitioned into the investing world and your mindset on the path to becoming a successful investor. I strongly believe that investing is all about building a web of knowledge. The more pieces of that puzzle that come together, the better investors we can become. Now, if you are interested in a copy of this book, I have left a link below. It is pretty small, maybe 45 to 60 minute read, if that, but there's a lot in here, like I said, that you guys can take away from. However, I do appreciate you guys taking the time to watch this video. Feel free to hit like and subscribe, and I will see you guys in my next video. Cheers.